Good afternoon, everybody, and welcome to the Elite Traders Club education session for what's the date today? The 26th of August 2015. Certainly been a very volatile week on the markets, and no doubt everybody's aware of that. And hopefully not being belted too much, given that our market risk indicators for the last few weeks have certainly been moving more and more to the downward side. This is part two of what we're labelling common trading mistakes. Part one, if you missed it, is available in the ETC portal, again under the education section. So today, part two, what do we have in store? Let's go and have a look. These are some of the things we're going to talk about in this particular session. Again, a lot of topics here straight out of Kel Butcher's book called 20 Common Trading Mistakes. It's a fantastic read. If you don't have this particular book, I suggest you go out and buy it. It's certainly, even if you've well experienced in the markets, it's certainly a handy little book just to have sitting on the bookshelf there in case you're wanting to point somebody in the right direction in terms of helping them to understand what are very common trading mistakes and at least being aware of them before they set foot into the market. So today, a couple of topics. It's not my fault. I didn't even know it was a mistake. I wonder how many of us have learnt through our experiences and then sort of realise, oh, goodness, I didn't even know you weren't supposed to do that. Certainly happens in any learning environment, but particularly so in the markets. The horse goes in front of the cart. Reminds me of a story that my grandfather told me years and years ago, who's passed away now, but one of the things he used to do back in the old school dances was midway through the dance, sneak out the front and go and get the horse and jig and unstrap the horse and put him back in the jig facing the opposite direction. So that when everybody else came out, the horses were facing the cart. Anyway, where's the exit? Exclamation mark, exclamation mark. I think everybody's been there and done that. Hopefully that's not the case anymore, but certainly early on we get so hung up about our entries and what stock to pick, we put very little emphasis on where to get out. Overworked and underpaid, what does that mean? I'm sure at some stage throughout your experiences in the market, you've probably found yourself being very, very active with very little to show for it. What does that mean? And what are some symptoms of that? And how do you know whether that's actually occurring to you? Have you actually stopped and taken a step back and had a bit of a think about what's going on with your trading? Confusing timeframes and strategies. Again, one of the things that we try and do when clients are jumping on board with the Elite Traders Club is, as part of their introductory survey, is discuss some of perhaps their styles that they might like to investigate when they're first starting, and talking through some of the practicalities of those and making sure that they're in alignment with those particular goals. So that's what we're going to talk through today. But first, I do have to give the disclaimer that today's session, as per other sessions, are purely for educational purposes, not to be construed as a recommendation because it doesn't take into account any of your investment objectives, your financial situation, or your particular needs. So as always, please make sure that you consider whether the advice is appropriate in light of your financial circumstances. All right, the first one, it's not my fault. I didn't even know it was a mistake. A lot of people, when they come into the markets, are quite unaware that really for safety purposes, we need to have some inbuilt rules to keep us safe. I always use the examples in workshops. If there's any farmers in the room, as an example, and talk about, when you're walking around the side of a horse, that there's a, frog in the throat, that there's a safe distance to stay away from particularly the hindquarters of a horse. And you certainly learn that if you haven't already experienced it before. So not knowing that it's a mistake to walk too close to the hindquarters of a horse, you could certainly end up with a pretty serious sort of injury. So understanding what mistakes look like before you enter the market is certainly, I think, a very wise thing to do. And a book like Kel's is a great starting point. Unfortunately, though, being humans, we learn through our mistakes, and investing and trading is very experiential, meaning that we learn through our experiences, both good and bad. Sometimes we make mistakes in terms of what we think is right or wrong. We make mistakes and we end up with a good outcome. And that's a very difficult thing early on because you're not actually aware that the good outcome was achieved through making what in the future is going to show up as being a poor decision. So these are sorts of things that in hindsight we tend to learn and take notice of. So certainly if you can learn that beforehand, you can save yourself some anguish and certainly some money. Not exiting when you should. And that often comes from not knowing how to exit. It's probably the hardest element of being involved in the markets is the concept of getting out of your holding, whether that's for a profit or whether that's for a loss, or whether you've been in a position where you've been able to trail a stop. You have your rules to try and keep it simple to make it less taxing on you emotionally. And if we keep it black and white and simple to follow, then we're much more inclined to follow our rules. There is always the possibility that you choose not to follow your rules and you choose not to get out when you should. And as a result of that one instance that you happen to do that, the stock races back in the correct direction, saving you from what would have been a miserable loss, or a small loss, or whatever it is. And that makes an imprint on your brain that says, okay, it's all right for me not to follow my rules because I just forgot to follow my rules, or I deliberately didn't follow that rule, and I was proved right. I'm still in the trade and I'm making money. Well, that's the sort of thing that's going to come back and bite you on the backside. I think you've all probably had experiences like that. I know that I certainly have along the way. Not understanding position size is another critical element for anyone who's ever bought previous reports suggesting entries and stop loss levels. It's a common undoing of many beginning traders not understanding the impact of position sizing, and people not understanding how to calculate it and not understanding the impact on the overall portfolios that they might be running. So it's really important that you understand these particular concepts, and I know that all of you that are a part of the Elite Traders Club certainly should well be on top of that. Taking a profit too quickly. I spend a lot of time going over old trades and continue to go over current trades as well, and looking at the impact of taking profits too quickly. We did have a system or some rules that said once we got to 1-to-1 or 2-to-1 or 3-to-1, depending on what the market risk was at the time, that we would take irrelevant profits rather at those particular levels. It's become very, very clear. I've put in a lot of work over the last few months, going back over 3 years of trades, and the impact on the overall portfolio performance is significant if you manage to trail your stops in an upward manner, in an upward but patient manner, and look to stay in those trades for as long as you can until the price dictates that it's time for you to exit. So rather than looking to take those profits early, there's actually been a significant number of trades, whilst they have been profitable in the past, and I'm talking trades that have been returning somewhere between 10, 15 or 20%, that have actually gone on to be 40, 50, 100% winners. And many trades, instead of having a profit of 20%, have delivered up to 60, 70% in a very short space of time thereafter. So getting out of your trades too quickly is certainly one thing that you don't want to be doing, because it has a significant impact on your overall level of expectancy. Now remember, your expectancy is a combination of your strike rate and your profit factor, if you like. So if you put a lid on your profit factor all the time, capping the amount that you can actually make out of your trades, then you have to have a very high strike rate to remain profitable. So it's one of those things that is difficult to teach. It's a little bit counterintuitive sometimes, particularly when the market appears to be in much higher risk much higher risk models. But it's certainly something that you need to learn to deal with. We do have lots of retracements in a rising market. The one that we're having at the moment is particularly savage. and only time will tell, the full extent and how far it goes. But that's part of our market risk and part of our trade management along the way that we need to be on top of as well, because if it does really turn into something very, very nasty, then we'll be stopped out of positions along the way, and certainly not hanging on in dire hope that things are going to return to back what they were. Very importantly, that last one, not accepting personal responsibility. There's been massive growth in self-directed investors over the last 7 or 8 years. And it's a little bit ironic, actually, in that it was the GFC that has driven, to a large extent, the desire for greater control. And since that time, we've, other than probably about a couple of years during sort of about 2010 through to about 2012, where we had the Eurozone crisis and the whole Australian market in particular pretty much went sideways. Other than that, we've sort of had pretty much a rising market. The Australian one hasn't been all that flash, but the US one certainly has been very, very good. And I think a lot of people are perhaps, it might be the big elephant in the room, that people are actually quite unaware of what to do at this particular point in time, particularly faced with quite a severe retracement at this point in time. So certainly accepting personal responsibility for your investing outcomes is really important. All right, next one on the list, if I can get my mouse to work, and it's good old technical issues. I'll see whether I can do it with the page down. There we go. That's a little bit easier. The horse goes in front of the cart, unless my grandfather taking the horse out and putting it around the other way. Jumping into the markets before having learned the required skills. Fantastic quote at the bottom here that I just want to allude to at the moment. It says, human beings who are almost unique in having the ability to learn from the experience of others are also remarkable for the apparent disinclination to do so. And I think that hits the nail right on top of the head. There's lots of opportunity to learn from the mistakes of others, and I think that's a really good way to start out. Certainly, as I mentioned in that first slide, trading is experiential, so you do have to feel it for yourself, and it's very easy to ignore the learnings of others and suffer the consequences as a result. So certainly if you can do some learning before you actually step foot into the markets, then the chances of you experiencing some severe pain is going to reduce. Really important to build strong foundations. And again, you're only going to do that through a degree of experience, but at the same time, building some relationships with people that have been in the market for a long, long time and can provide experience and wisdom about the markets and all sorts of different market conditions as well, I think is extremely valuable. Teaching old dogs new tricks. It's a tough one, investing, because we tend to we never learn how to do it in a formal sort of process. We're taught about investing is primarily for the long term. Most of us, our first sort of investments are our homes, and from that point of view, we tend to think of buy and hold and residential property, for example, in Australia over the longer term has been a very good investment, and a lot of people made a lot of money out of it. There's certainly good times when to be in property, as an example, and there's other times when it's very tough. So they're the sorts of, I guess, learnings that we've had in the past that sometimes we carry over on into the share market, which is a totally different market altogether. And trying to unlearn some of those preconceived notions, which might serve you well in one market and not necessarily in another, are difficult to unlearn or at least reassign, if you like. Very important as part of your choice of investing that you come across a methodology that suits your personality, and we touched on this a little bit the previous week as well. A lot of people, when they're first drawn to the markets, are in a hurry, and as a result of being in a hurry, tend to throw caution to the wind. They don't have good risk management practices. They don't understand the need to have a clearly structured trading plan. Your trading plan doesn't have to be difficult. In fact, I think the simpler it is, the better. And obviously throwing caution to the wind, they, if not sooner, hopefully it's sooner, but sometimes it's a lot later, get their lessons taught to them. So a tip for everybody when you're first starting out, just go slow down, make sure you can walk properly before you run. Otherwise you're going to trip over and really do some, if not emotional damage, certainly some monetary damage along the way. And depending on how old you are, you may have time to recoup from that. I know a number of clients from many, many years ago who decimated during the GFC, just starting to get back to some level of normality now, and I think there's a lot of fear in the markets right now. So certainly I think taking on board your learning, making sure that you're understanding, so when you come to times like this in the market, you know how to handle yourself and your investing, because you're using a plan. The exit, where is the exit? It's something that we all need to think about as soon as we get into a trade, even before. The most important aspect, whereabouts is my stop loss? How do I manage the trade once I'm in the trade? There's certainly a lot of focus for people learning, trying to finesse their entries. And whilst the entries are important, certainly the management of what you do once you're in the trade is certainly of higher importance, because if you manage things well, then there's every chance that that the investment, that the trade that you're in, is at least given every opportunity to move in the right direction. But as always, as investors, our focus is on risk management, and so we always need to know where the fire exit is in case the building catches on fire, and that's very, very important. One reason why a lot of people will negate the exits is because they always want to be right, and it's tough admitting that you're wrong. I know some members who have been on holding stocks for years and years and years, and they say, "Well, David, it's not a profit until you sell." Well, some of the losses that they're sitting on are quite significant, and I'm sure there are people out there who still got Rio that they bought at $120, hoping that the stock's going to come back. Well, it may well eventually. It's going to take a long, long time if it ever does. And so you've got that time cost as well. People are eternal optimists. It'll come back. It just needs time. Certainly it doesn't work out that way in the markets. If hope is or optimism is your primary investing method. And so on that basis, if we can make things as mechanical as possible, some very, very simple rules will help that. Nice little Chinese proverb there. If you must play, that is, if you must be in the markets, decide upon three things at the start. What are the rules of the game? What are the stakes, i.e. what are you playing for? And when is it time to pick up your bat and ball and go home? When is it time to quit? And I think you need to be able to know all of that. I have a friend who's been a self-taught just about everything. Left school when he was in year 9. Has developed his own concreting business. He employs about 20 people, and over the years has provided some wise counsel to myself. I remember many, many years ago when talking about an investment property that I was purchasing, and he said, "Dave, look, it's a great idea, really good idea that you're doing that, etc." And he said, "What's your exit plan? Things go pear-shaped," and it struck me dumb right at the very point, because I was so focused on buying first investment property, thinking about all the good things that were going to happen, looking into the future, and it didn't occur to me at the time that I didn't have an exit plan. I think it's really important to make sure that you've got that at the forefront of any investing that you do. Overworked and underpaid, overtrading. It's something that a lot of people get themselves caught up in, particularly traders first starting off. They are very attracted to short-term trading in particular, and they can find themselves really a screen jockey, if you like, spending a lot of time in front of the computer, really putting in lots and lots of effort, trying to find winning trades, jumping in, jumping out, and then over a period of time they realise, well, what's the impact of all of this? What's happening with my account balance? Is it still the same? Is it higher or is it lower? And it's only when you reflect after a period of time and you have a look at your broking statement and you realise that your account, it might be the same as what you started with after 6 months. And you go through it and think, well, okay, well, I'm learning lots. You have a look at your brokerage statement and you realise that whilst you haven't made any money, the guy in between you and the market, the broker, is getting a clip every single time you buy and sell. And those brokerage amounts can add up to a considerable amount. Particularly if you look at it over, the course of 12 months. If you're a short-term active trader, you can find that whatever money you make, by the time you take into consideration the brokerage, you may well find that your broker is taking 50, 60, 70% of your actual profits. And it's only when you go through and do all your bookkeeping, etc., that you realise that. And so obviously trying to minimise the impact of your brokerage, and the one way that you can do that is not trading so much, not being so active. And this is something that, again, it's something that will be a product of your personality and how you like to deal with the markets. If you're a person who likes to be constantly active, can't sit still, gets bored reading a book, then you're probably the sort of personality that's going to be drawn towards more of an active style of trading. Those of you who are like that but are finding it very, very tough are going to have to learn to become a little bit more patient along the way. There's no point being impatient and trying to force your trading as a result of that. Some other things for you to think about: your physical health and your emotional state. If you are finding that you can't sleep at night because you're constantly thinking about the markets, then it's very likely that your risk levels are either too high or there's certain things that you are lacking in your understanding of what you're currently doing. Because if you're fully conversant, fully understanding of your level of risk against the relevant market conditions, then you should be fairly comfortable and calm through the whole experience. Certainly markets like we have at the moment are not particularly enjoyable, particularly for the longer term style of investing, but they're just part and parcel of it, and something that is going to happen from time to time. You need to start thinking about, reflecting, what's the journey been like, up until these particular points in time. How has your trading plan equipped you better for engaging with the markets? And certainly if you're waking up in the middle of the night, if you're making mistakes with your investments and your trading, etc., if you're trying to second guess things, etc., then it's likely that there's a gap in your understanding and you're not quite at one with your objectives and what you're trying to achieve. Nice one there. Discipline is the bridge between goals and accomplishments. That was one from last week, but it's certainly got relevance to being overworked and underpaid. The last one here is confusing timeframes and strategies, and we touched on this early on to a certain degree. Are you short-term or long-term? It's interesting how when I first started, I was very much short-term. I thought long-term, you can't make money long-term. That's ridiculous. I'm short-term because the more trades you have on over a certain period, the more opportunity you've got to compound your money along the way. And you'd have to be silly not to realise that. I mean, after all, Einstein was the person who built up the concept of compounding over a period of time, and obviously the rule of 72, which basically says your rate of return, if you divide that into 72, that's how long it takes you to double your money. So if you can make 6% a month, then it's only going to take, 6 into 72 is 12, so it's going to take you 12 months. But if you can do 10% a month, then 10 into 72 is 7 months. That's how long it takes you to double your money. So when you start thinking like that, you start thinking, well, more trades I can do, I can get to that 7% or 10% quicker. I'm going to be able to double my money in a shorter space of time. So a lot of people think like that, and it's a very difficult thing to unlearn. When your short-term trades go wrong, then all of a sudden, because you don't understand risk, you say, well, that short-term is now going to become a long-term trade. And you go back to using optimism and hope as your primary strategy. And again, that's not something that is going to deliver you too much in the way of success. So certainly having clarity is really, really important. And a key theme here is, clarity comes from having a process that is simple and easy to follow. And if you've got that, then that's all you need to be focusing on is your process. If you think of those of you with your own level of work, whatever it is that you do, most of you undoubtedly will be following a process. It's what got you to where you are. You understand the formula, the process, the steps, the risk management, whatever it is that you're doing along the way, and that's how you become successful and get to stay in your job and earn money over lots and lots of years. If you keep straying from the instructions, the template, if you like, for your work environment, then you're going to end up in all sorts of trouble. If you don't get the sack, then it might be your business that suffers or whatever. So committing to that plan, making sure that it's repeatable, and over a period of time, that's how you're going to be successful. So in determining that last bit, the last question there, what's your best fit? Really important that you understand the way that you like to invest and integrate with the particular markets, and that whatever method that you're learning suits your personality. And if it does, then you're going to find that success comes your way a lot easier than it might otherwise would. Nice quote down the bottom there from Ralph. I wish to say what I think and feel today, with the proviso that tomorrow perhaps I shall contradict it all. Certainly a huge degree of uncertainty in that particular statement, and it's not the environment upon which you want to, or from which you want to be investing. All right, so just to wrap things up today, folks, foundations. Again, if you're building a house, you want to make sure that you've got nice deep foundations, really, really strong, so that the learning and the investing that you do upon those particular skills is built on strength, built on experience and your understanding of a very simple but robust trading methodology. Continue to learn, read books, speak with others, learn as much as you can about the markets. And once you've got to a level where you're proficient in your understanding, particularly of the risk elements of it, then a good way to reinforce those skills for yourself is to teach and explain it to somebody else. Understand your mistakes. And that really is not just saying, well, look, accepting a mistake, okay, I made a mistake, but understanding how they occurred and why they occurred, and doing everything you can to make sure that they don't happen again. Again, I think it might have been Einstein who said the definition of stupidity was doing the same thing over and over again, expecting a different result on each time you do it. Make sure you look after your health. There's more to life than the market, so along the way, make sure you pause, think about that, get some regular exercise along the way. It's certainly going to benefit you and keep you in the right state of mind as well. And lastly, very importantly, find an approach that suits you, which is, I think, a very, very important one, particularly for if you're going to be doing this over a longer period of time. There's no point jumping from approach to approach to approach, hoping that you're going to find one that is the holy grail. There is no holy grail. It's a matter of finding a process that you can actually commit to and actually doing it. So I'll leave you there with the quote there from Dennis Waitley. Mistakes are painful when they happen, but years later, a collection of mistakes is what is called experience. And I think it's very, very true, particularly with the markets. So I'll leave you with that. Are there any questions for today? It's probably not so much a Q&A session, but just a bit of a reminder about some of the mistakes that are very easy to make. And I think acknowledging mistakes along the way, even though you may not necessarily have made any of these mistakes before, is a good way just to be on your toes and keeping an eye out for the possibility of any little slip-ups along the way. All right, well, that's it for the time being. There won't be an education session next Wednesday. We have the Academy, so I'll be busy up there for that. There will be a weekly analysis session, which, if I have time, I'll try and do it live, but if not, it might have to be a recording. So, but there's certainly the watch list, etc. Everything will be updated as per usual. Right, folks, I'll leave you with that. Thanks for tuning in, and we will catch up with you at the next education session next Wednesday week. Okay, bye for now.